Good morning. I set this up to start at 9:05. And there's only nine of you, so I'm going to wait. I want you to think about, though, where you want me to start. I think I'm going to start where I left off and then get into a new set of notes on cost of equity. Cost of equity continued, I think that's what it's called. So in the chat, if you can write down what you'd like me to look at today, I'd appreciate it. Otherwise, I'm just going to start where I left off here. Okay. So let's see, you guys have some questions. Exercise 7 in review 3. Well, what I'm going to do is I'm going to discuss the last set of notes that I gave you, that I shared with you. And then I think review 3 is part of that. Let me double check. Yeah, review 3 comes as a result of learning that set of notes. So I'm going to actually discuss those notes. So you're going to have to just hold off, Brenda. So are you telling me then that you guys read through cost of equity on your own? Okay, I just wanted to say something about this exercise. I did this problem. This was the last thing I did before we took our break. Well, it was intended to help, just to allow you to catch up, and yeah, I didn't want to cram more information into your minds. The exams are with the grader. We are working out the solutions because I changed a few things from my original questions and my solution set. So I needed to verify those with him. And anyway, he's a good grader. It's just a lot of work to get through your test. So you'll get those. You'll get those soon. And I'm going to introduce new material. I'm going to go through this first, and then I'm going to introduce you to the material on capital structure. Okay, so let's do the best we can with the remaining notes. And as I explained, you've seen this before. I might just be going more in depth with what you've understood before. So, but it should be somewhat familiar. So in this exercise that we covered, this is the solution set. I explained that there were out of equilibrium. So these were off the security market line. So these were out of equilibrium securities. And we discussed how these would be forced onto the security market line by an adjustment of price. So what you're supposed to do here is use the information given on risk. That's how it was presented. So you were given the betas as a measure of risk for A and B, and then from the beta you could calculate the position on the line. So I give you, so with the information you're given, you can compute the line, and then it's like making a prediction, right? You use this value and you get this value here. So this is where you should be for this level of risk, but you're here. And I explained the adjustment, and I did the same for A. For B, I explained the adjustment process and explained that this was an overvalued security. So the price needed to fall, and that's synonymous with the expected return rising to this point. Now, the only thing I want to add to that is that when you identify, when an investor, prospective investor or investor, meaning someone holding the security or someone looking at holding the security, when they identify an overvalued security, if they have it, they will sell it. Okay, if they don't have it, so someone who's looking at buying it and they see an overvalued security, they know the price is going to fall, so they should short it. So short refers to making an arrangement, likely through a broker, to borrow the security. You borrow the security and you promise to return it at a later point. Because you know the price is falling, when you have to return it, you can buy it back in the market for a lower price. Okay, that's how that works. And in the meantime, you realize a profit. So this is basically what I want to say. So when securities are overvalued, you short them And when securities are undervalued, like A was, you will long them. It means you know the price is rising, so you're buying it for, it's cheap. It's barato. It's a low price. So you buy it, you long it, and you hold it. You buy it and you watch the price go up. So that is just to explain what I was talking about here if you didn't know. All right? I missed that part. I was already over time, so I thought I could mention that now. Got that? So I do have another set of exercises I could give you if you're really interested. So I'll ask you again when I finish the discussion if you want another set of exercises before before the test. So I'm going to post the final test, which will include this and additional material I'm going to give you. Just like before, I'll post it on Saturday, and I could actually let it be due on Sunday without a problem, as long as I have enough of Sunday to grade it. All right? So we can discuss that as well. So there's two things to talk about. Let's get into the last set of notes that you may or may not have reviewed, and then the last solution set, and I'll answer any other questions you have. Okay, cost of equity. So I'm going to discuss this as though you haven't looked at this yet, because I didn't present this. All right. So this is your capital asset pricing model. This is the line where you have an adjustment. This is pricing or determining the expected return of a security for a firm. The prospective investors in the firm expect a return that is a markup above the risk-free rate that adjusts for risk by the market risk premium. So this is the market risk premium. Remember, now the symbol here I'm using is more general, right? The expected return. Now I've also gone to lowercase r's. This is from the textbook I was using, where it went to the lowercase letters. So this is for, in general, the general case where you get ex-ante returns and you estimate the expected return, not necessarily the weighted average, not necessarily just the simple or regular average. And so this is the market risk premium. This is the slope of the security market line. If you didn't hear me talk about that last time, have a look at that video. And for every unit of risk measured by beta, it adjusts by the market risk premium. So this is the compensation. This is the premium, the little bit extra over and above the risk-free rate that you should be compensated, or investor prospectively looks at being compensated to for taking on the additional risk. So how do you calculate the beta? Beta, remember, is the slope of this, is the slope. So again, the security market line slope is this, but that's a different axis, right? This is the slope of the scatter plot. So this is a different, this is for the security market line. And this is the slope of the scatter plot. The scatter plot between, I still didn't buy my new iPad, so bear with me. So this is always, right, the scatter of the market returns and the asset returns are here. Okay, now I'm using S, even though I used I before, this is like S for stock. Okay, so what you're seeing here, I'm going to determine the slope of the scatter plot of those observations. Now, back to historical data. Here's the example. Now, this is the information from the UR case, that's part 2. In the UR case part 2, you're given information on those years before the financial market collapse. I give you some more data than we started with in the notes. And these are the returns on the for the market, represented by the S&P 500. And these are the returns to UR stock. Okay, so it was dramatically affected by the stock market crash. So we go through the trouble in the notes here, and I calculate using historical. So remember, this is historical data, so you have to use the formulas for historical returns. We calculate an average, the regular average. And that's done here. So the average for the market, for the stock in the firm is 11%, and for the market over this period of time is 5%. Then we calculate this is the notation for historical data, so I use that. I could use S, or this is the estimate for the standard deviation, and I use the columns, right? I just copy the columns out. I keep a lot of decimal places. Some people ask me about how many decimal places they're supposed to store. I guess I'm doing overkill here, but in the exercises I'll tell you, usually it's 2% if you present, like for rates, right? They're percentages. So it's going to be 2% if it's represented as a percentage or whole percentage, or it's 4 decimal places. So yeah, this is overkill. I probably could edit that, but I want it to be precise. Alright, so I calculate the standard deviations. Now these, you know how to get this out of your calculator, so you wouldn't have to do all this, right? Do you want me to give you a moment? How many of you actually looked at these notes? How many of you read through these and had no issues? Let's put the 2 questions. How many of you looked at these and how many of you had no issues? So I want to know how slow I need to go. Make a note. I'll make a note first. You guys are quiet. Yeah, so you guys are, half the class is here right now, but I do see lots of views on the videos, so I'm assuming everyone gets around to watching them. Okay, so nobody's saying anything. Just let me know if you haven't read the notes. I'll continue to go slow. Okay, I'll just continue. So you could actually punch these numbers into your calculator and get the standard deviation, correct? Oh no, this is not standard deviation. This is a standard deviation. So I'm using the formula. Right. Okay. So I'll continue to go slow then. A few of you just commented. So let me see. I'm going to use the formula for beta. So there were 2 formulas for beta. Okay, there are 2 formulas for beta. One was the variation on the slope. Remember, I was saying to you that the beta was just it was the correlation times SY over SX, right? So risk. This was the simple way to understand it. So I explained to you that was the slope. Can you read that? Let me do that a little better, cleaner. So it was R, S, SY over SX. Risk. So we're going to make the equivalent formula here. So R in Greek is rho. And you can put the subscripts down. So if I want the beta for S, then it's the correlation of XY. Like you have to put them in order. Well, the correlation of the market returns with the stock, and then times R standard deviation on the variable that's in the vertical direction, which is S, over the standard deviation that's in the horizontal. Okay, so that's the formula that I left you with. So that's rho MS, sigma S over sigma M. And then I explained that that could also be written like this. All I've done here is change the subscripts. Okay, so the point is that the slope is the covariance over the variance. So this covariance over the variance. So how they covary divided by the randomness, or how spread out the market returns are. Okay, so I could do this, and I actually it's easier to calculate covariance because the correlation actually comes from the covariance. However, if you have your calculator, the calculator gives you correlation. It gives you R, which is correlation. So that would have been easier with historical data. But anyway, you can double check. I'm going to encourage you to do that. So this is how you would write it down, long form. Why don't you take a moment and get the beta yourself? See if you get this in your calculator. I'll give you a moment. What I want you to do is go to the original numbers here and tell me what is the R of this data. So you're going to enter these as, which one's X and Y? Don't forget, always S&P is X and the stock is Y. Okay, so I've actually written them in order. Sometimes you might get confused because I won't give them in the alphabetical order, or I'll put the columns the other way around. You have to be careful. You can either rewrite them in the way so that you can enter them in your calculator without an issue, or just, I don't know, you have to put the headings to remember. Okay, so enter these X and Y in your calculator and see what you get. What I want is R from your calculator and B. I'll give you a couple minutes. Remembering you can only do this because the data is historical. You can put it in the chat. Yes, Brenda, the index, the way that we are going to use statistics for this class or finance, the X is always the index, the market returns. Okay? Now that doesn't matter for calculating R, which is X and which is Y, but it matters for calculating the slope because it has to be the slope of Y and X. The slope is the change over Y over change in X, so it does matter which order you're in. Okay, good. So that wasn't hard, right? What's R? It's Manuel. Okay, what's R and B? Looking good, looking good. Keep going. Okay. Anyone having problems with that? There's 16 of you, 15 of you. You remember how to do this, right? This should be second nature by now. X and Y in your calculator. And it shouldn't matter if you enter them as percentage or as decimal, as long as you're consistent. As long as you're consistent. Monica, you got it? Okay, yes, those are the right numbers. Alfonso has the right numbers. Okay, good. So, remembering this, okay, now what I want you to tell me is what does R mean and what does B mean? What does the correlation mean and what does the slope mean? Make an interpretation. Okay, so what I want you guys to do is interpret. Tell me in the chat what is R, or interpret R in the context of the problem, and B. Who can get it? Don't be shy. All right. Okay, Alfonso said that. Okay, remember, R is the direction and strength of the relationship. R is the direction and the strength. So you just mentioned the direction, and you said almost perfectly. That's really what I want to get out of this. So R is telling you, because it's almost 1, it means that it implies, if you want to relate the two, the variables are positively correlated and perfectly positively correlated. It means that B is a good indication, the slope is a good indication. It would be good to use that as an indication of the impact of the economy, or of the economy on UAir. Okay, so whereas the stock index is a reflection of the state of the economy when it's positive, and there are positive changes or positive returns or increasing returns, that's an improving state of the economy. And what this is saying is that B being 1.55, we interpret it as when, and I'm going to write it up. Yes, as the S&P 500 moves has a 1% increase in returns, the returns to UAir have a 1.55, so it's more sensitive. Okay, it's sensitive. It's not just it's 1.55. It's that and 50% more returns in UAir stock. So yes, Brenda, as the S&P moves 1, the UAir moves 1.5, and synonymously, as the S&P moves -1, or when it returns -1, the UAir returns -1.5 for every unit. For every increase. I'm writing it down. I'm not going to say unit. Every percentage increase in the market returns, UAir returns a little bit more, 50% more. Okay. All right. So, because R is perfect, it means the slope is a good indication. If R wasn't perfect, if there was little correlation between them, you could calculate B, but B wouldn't be so good at, it wouldn't be so reliable, okay? So I'm just going to add this point. It's reliable since R is +1, pretty much. Okay, good. So you can do this the long way, like this, or you could have done this, because of its historical data, you can do it the short way. Now the next question is, how do I get this number? I did mention all this stuff last time, but let's go step by step. How do I get this number from my calculator? It's the covariance. How do I get the covariance? So what you need to remember is R so be careful, because this R, the return, is different from R, correlation. Yes, Brenda, R tells us how reliable the slope of the calculation of V is, like as a predictor. Okay, so since, back to my question, right, like if the data, and let me go back to the picture because that helps me explain. So if the picture is like this, you know, it's not perfect, it's not exactly what we're looking at, but using the slope to make predictions is not that bad of an idea. But if your relationship was more scattered, like even more, you know, scattered like this, there's so much variation. There could be, you know, a line and a slope here, but it's really, you know, that line is not the best because this is so scattered around, and the R will tell us how scattered it is. Okay. That's alternative to if it was actually like, you know, a straight line like that. That's what we're actually looking at right now. Okay. Got it? All right, back to my question. So how do I get this number out of my calculator? To get correlation out of my calculator, we remember that R is equal to, correlation is equal to covariance XY. I'm running out of space. Let me do it here. R is equal to covariance standardized. All these different notations. This is the one I like because it just looks much more simple. So R is just the covariance divided by, so the standardized covariance. So that means if I want to find this, I'm just looking for this, I need to take the two standard deviations from my calculator as they come out of the calculator and multiply it by the correlation. Now that was easy because it's pretty much one in the calculator. So you just need these two and you can get this. So what I'm showing you is you can do it the long way if I ask you to, but if you really want this done quickly, you can either use Excel or just get the results in your calculator and multiply correlation, unstandardize it in a way. You just unstandardize it. Unstandardize the correlation. I'll give you unstandardize. I made up that word, but I make up lots of words to help. Okay. Got it? Right, so Monica is asking me if R was -1, B would still be a good indication. Yes, because it would just be a straight line going the other way. So if it was going like, if the dots were going like that, still that would be a good predictor. Right? B would still be a good thing to look at. Here. Good. You guys are synthesizing. Very good. I really like to make that point because we use B a lot, but it's important to put it in context. Is it a good thing to use? Or I will tell you that. Is it a good guess at the relationship? All right, so you have techniques now. So let's see. We got a R 1.55, sorry, an R of 1 and a beta 1.55. All of this stuff can come out of your calculator because you're working with historical data. All right, now this is the, well, not confusing, but I do need to explain this next slide, unless you have a question. Okay. What we're going to do next is get the CAPM. What is the goal? Our goal is to estimate the expected return. Now, let me make a point. We have an expected return. The expected return for the security is 11%. Okay, so this is one measure of the expected return. And I explained to you that that's not the greatest when there are extreme values. It's not the greatest idea to use the average. An alternative would be to use the geometric return, maybe from the numbers. A different model, there's two other models I'm going to introduce you to. So this is just using the historical information. There's other information you might want to incorporate, right? So what if you want to incorporate the state of the economy and how the returns respond to the state of the economy, the returns for this company's stock? And that's what the CAPM will do for you. So that's what we're going to use. Now we're going to use the CAPM to estimate the return as an alternative. So how do we do that? Here's the information I gave you. These are the returns to a 90-day T-bill that represent the risk-free returns. So there is some variation, but so for that we're going to calculate the average T-bill rate over time, 2.365%. So that's just the average of these. And the average market return over this time if we go back, was 5.11%. Got it? So these are just averages, simple averages. So we will call now, I'm going to use that information for what's called the average historical market risk premium. It's just the market return minus the risk-free rate. If you vaguely understand market risk premium and go back to the last couple of videos, I talk about how to calculate that and what that is. So it's just saying it again, it's the addition, it's the expected return, a little bit extra over and above the returns on the risk-free rate that investors require to be incentivized to hold those securities, in this case the market portfolio. So the market risk premium on average historically is 2.753 repeated. Now that's the average historical market risk premium. If the current T-bill rate is 1% and the beta on this company's stock, remember the S is represents for the stock in the company, and I'm going to say something more specific about that in a moment. And then we're going to replace this with the average historical market risk premium. Okay? Now if you get confused, like, the reason is because I don't have this information to calculate it this way. Okay, I don't have the information to compute the expected return on the market using ante data. Like, so more, if I had more information, I could do it this way, using ex ante data about with a distribution of market returns for the future, my crystal ball that I talked about. I don't have that. So the next best thing is just do it this way. So this is a substitute for this. Okay, so this is if you have just historical data. This is how you do it if you have ex ante data. Notice this has no bar on it. Okay. But because I'm using historical data and I want to make it comparable, I use the average here, and there is a bar on it. All right, bear with me. I'm just trying to point out why this might look a little bit different. So there's the calculation we just made on the other page. This is the one we made on this page, and this is given. This is a current T-bill rate. So notice, even though I have no bar here, I have a bar here. Don't let it bother you too much. I'll give you instructions, and you get to use the notes to answer this on the test, so you can follow along with what I've done here if I ask you, if I give you the information this way historically. All right, so what do we get? Put it all together, and you get the required rate of return. This is what you've calculated. You've calculated the expected return to stock for UAIR. So this, according to CAPM, is the return that investors expect when investing in UAIR. Synonymously, it is the return paid in efficient markets. It's the return paid to investors in UAIR by the firm. Okay? Now, I actually have some notes on efficient markets, not notes. I gave you, right, for the Connect. We didn't even talk about Connect. The Connect assignment had problems from chapter, I can't remember the chapter number, but it was on efficient markets. So I'm going to speak freely about efficient markets. Hopefully you had the chance comfortably to look through those notes. And the test will involve, that's just background reading, really. The test is going to be focused, remember, the last test will be on these notes that I've just given you on since the last test. So the we began with the statistics review, and then capital asset pricing model, and then what we're doing now. Okay, that's going to be on the coming test, together with capital structure notes that I'm going to give you later today, or we might just start them tomorrow. All right, so now we have this. So that's what we found. It gives me the return that I should use for valuing the firm. Alternatively, if I take the average T-bill rate over time, this is the, remember, this is from the slides, actually, between 1928 and 2010, the average T-bill rate was 3.7%, with the average return on the stock market of 11.3%. So I'm just looking at a longer horizon, or a longer period of time. So the average historical market risk premium over that period you could calculate just like above, but I'm going to use a larger set of data from the data I gave you. So you're going to have to look back at those slides if you really want to confirm those numbers, but that's where it came from. So historically, over these 80 years, 90 years, no, that's 80 years, it was 7.6%. How does that compare with this one? Over this period, the market risk premium was just 2.75. Right? Remember, this is a very volatile time. Different expected returns. So if we were to use all of this data instead, so again, because you're students, I will tell you which which one to use. But you see the sensitivity in your results. You're going from a return, you're estimated using the capital asset pricing model of 5% if you use data over that specific period. But if you use the historical information, you have double that, 12%. Okay? So this is very different than if you use the last 6 years of T-bill data. And because this is high, right, this is for investment projects, if you have a required rate of return that's almost 13%, it's a lot more strict about accepting projects. When these are different, the convention is to use the more current data for a reliable estimate of the cost of equity. This is a point that I'll usually guide you. So what I'm going to do is evaluate the information that I give you in the case using the, no, sorry, not in the case, well, the original case, part 1, with the total project cash flows of the problem. We're going to evaluate whether we should accept the UR project. Remember, we were using a discount rate of so we were using a discount rate. If you remember the UR project, we were using 10% before. Now this is saying, incorporating the risk inherent in the market, in the stock as relative to the market, we are going to use almost 13% instead of 10%. This is the better estimate. Okay? So this is where we started in the previous notes. This is what we have as an improvement. And there's one other way we could have done this. Okay, so let me say this all again. So we could have just said 11%. Look at that. 11% was if you just use the average return of this period. But this is older data, right? I would have to use more recent data. And so that's what I did. I used more recent, well, I used a larger amount of data to get a more stable return, more robust return, and I end up with about 13%. So I went from starting with 10% to looking at, like, this would be for the firm. If I just took the returns over a period of time, that would be another way. This would be the way using CAPM. So I'll just say 12.8%. This is CAPM. And this was what we used for part 1. Okay? So they're not that different, but, well, you'll see what it'll tell you how sensitive, well, how restrictive this is. IRR will help with that. Okay, so this is the initial number. This is the one we just computed that we want to use. And what about doing it this way? What is going on here? So I gave you some exercises doing this. I don't know if you got through them, but let's work through this together. This is trying to apply the dividend growth model. What was that again? The dividend growth model makes some assumptions to help you calculate R. So this is the formula here. Remember, this just comes from taking the formula for the perpetuity formula with the inherent assumptions. So it's the growing perpetuity formula, right? What you do is you say, okay, well, we're going to assume the dividend starts as C1 and then grows at a constant rate of G, and that the required rate of return is going to stay the same indefinitely. So this would be the formula that you would use with those assumptions to value stock in the company. Rearranging this using the same assumptions, I could in turn rearrange this and get this. That just comes from the formula I just erased. And this, same sort of thing. I could calculate that expected return if I knew the current price, with the inherent assumption of constant growth, and this being the next dividend. So this is another way to calculate expected return. So the first way would have been to just use the average. The second way to use the CAPM. This is like the third way or method. And we refer to this as the dividend growth model. So what do you need to compute it? So I'm going to call this RS, but it's just the interest rate of this relationship. So what I need is if I'm starting the data set, so these are old data, so using historical data over its period of time, the next one would be, so if now is 2011 just passed, the one that's coming is 2012, right? So we're going to call that dividend 2012. The price today is price 2011, and we need to find G. So these two things are found with the assumption of constant growth, which it's not constant, right? These are not growing at a constant rate, but we make the assumption. How do we do that? We force it. We run between this period and 2011 and say there's a constant growth rate. You see, that's all that is. That's a constant growth rate. Let me make this a bit bigger. If G was the rate for 6 periods, growing from 20 cents a share, then I should be able to solve this expression and predict what the 2011 share was. So I use everything I have. So you can make a little formula for yourself if that helps. You could write 1 plus G, you can say T, and you could say D1 equals, or D0, this is D0. This is a different D0. See, that's the thing, it's going to be confusing. So in general, let's say, so we'll say D0, and that will lead to DT. Okay? So if you start at some point, add T, that's DT. So this is the formula, and I can solve for G using this formula. So this is going to be the constant growth rate over that period that then I use to project the next share. I project it as 25 cents return for the share. Sorry, the next dividend, not the next share, the next dividend for each share. And so that will be the dividend this is the last price, and then the growth rate I computed here. This result is much different. It's half of what we had before. Okay, so again, using a low rate like that it'll cause you to accept more projects, right? That are investment type projects, because you're not setting such a high requirement. Okay, so you have three models. You could just take the average of returns in the past, you could use the capital asset pricing model, or you could use the dividend growth model. I'm going to proceed with this exercise, going back to the UR returns that we estimated, and I'm going to calculate the IRR, because I have this conflict, right? I have to choose between discount rates. Which is the right one to use for my project? So let's just get the IRR and let that help us. So here we go. These are the returns. Some assumptions that I've been making without explicitly stating them. We are assuming that UAir is an all equity firm, so all we have to do is value the stock. Okay, we're not looking at other assets, just the stock of the firm. We've also assumed that because we have no information, we've never conducted the UAir project. We've never flown to the Bahamas before. We don't have any information to calculate the beta for the Bahamas project, so we've assumed that the risk inherent in the Bahamas project is no different than the other destinations. Okay, so the risk being the volatility of returns. So we just calculated the beta for UAir in general and used that to get the CAPM required rate of return. Okay, so taking these cash flows, I calculated IRR of 10.6. So we did this before. Now, notice if you use the CAPM of 5.27, the original one, with just a small fraction of the historical data, you would accept UAir. If you use the CAPM discount rate, though, you would not invest in UAir. This is not high enough. Okay, so this is very strict. It turns out to be much more strict. So you following me? The discount rate, which is the one you should use? And I advise you, I think we continue using this one. At this point, if you used 5%, you would actually invest in the project. So using 5% for this level of risk, we calculated on the line. So once we calculate using the CAPM, we find the return on the line. UAir is way up here. You see? So UAir, the internal rate of returns of this project, if you adopt the 5.27% determined by the CAPM and recent data, you would accept the project, because this is a, what do we call this? What do you call this asset? And what do you call this? It's an asset. This dot here, right? What did we just learn in that exercise at the beginning of the class? what did I call this? Anything above the line would be considered. Oops, no. It's undervalued. It's an undervalued project, so it's attractive because we know it's more valuable than it's currently priced. So we should accept the project. Okay, so if you use 5.27%, arguing, oh, we just want to use this current bit of data, if you use 12%, it would be a different drawing, right? If you use 12% instead, this because it was calculated from making a different assumption about the historical market risk premium, using a different set of data, the point here would have been 12%, 12.8%, and the UR project would have been down here. Right, so it would have been off the line, and we wouldn't have chosen it. Because it would have been it wouldn't have returned as much as we required. So determining whether you accept or reject the projects is directly related to what required rate of return you use. And so I think you already understood the importance of using the internal rate of return. This is a better way to look at this when you have doubt about which expected return you should be using for your project. Okay, someone will ask me a question. Degree report. I'm not sure what you mean, 10.65. Not sure what you're saying there, Ms. Manuel. So let me just, I don't know if I'm going to confuse you. I just want to outline what if. If instead we use the 12.8%, this would have been 12.8%. That would have been 12.8% here, and so 10% would be down here, and it would have been overvalued, and the project would not have been accepted. Slide 5. Do I have the wrong number there? Some typo, because I kept changing the numbers, and then I stopped changing them because it's easy to make typos. So what did I put here? G is, that's correct. And then this should be 2011 price. The price 2011 is 10.5. Yeah, thank you. This should be 10.5. I'll edit that. You guys check that, correct that in your notes. I'll give you a moment to clean that up. So this should be 10.25. Make sure you get the same answer. Does it change the answer? That's the problem with updating notes. That's why I stopped. It would make too many typos. Thank you for all your help in correcting my notes. Okay, yeah, works. So that should be to get the answer. Is everybody okay with that? Thank you, Manuel. So the discussion after that became which is the right discount rate. Using the IRR, you can start to debate whether, because the one that you choose will influence whether you conduct the Bahamas line or not. So you need to defend your choice. So if it was an undervalued project, you would accept. If it's an overvalued project below the line, you would reject. Okay, so this was an all-equity firm. Investors could use the information historically and some idea of market expectations to estimate the expected return for the company, and then look and see whether they're going to achieve those returns in the prospective project, and make a decision if they're going to invest in the company or not. In this case, we're just trying to figure out if we're going to if UAir should invest in its own project using that expected return. What if a firm is not all equity? What if it has also included investors as debt holders? So this is a good introduction to capital structure. The assets of a firm in the balance sheet are equivalent to what's owed by the firm, owed to shareholders and owed to debt holders. S represents the value of outstanding stock. So the current market price times how many shares there are. That's S. Oh, yes. Debt is the total value of outstanding debt. So how much the total value of bonds outstanding are. And together, those should be the firm's assets, right? So what's owed is what is owned by the firm in the balance sheet. So we say, if you know what shareholders' wealth is and you know outstanding debt, you know the value of the firm, V. So the market value of assets of the firm is S plus B. How many of you have seen this before? Who's seen this before? There's some delay here. Who has seen this equation before? Aha, you have to look at that for connect. Okay, so I'm going to go deeper into understanding this. So what do we do here? So we are going to distinguish now a firm could be all equity, or we say leveraged. So we have to talk about a firm that has stock and bond. A risk and return for a levered firm, a levered firm. So S represents the market value of outstanding stock. RS is the symbol I'm going to use for the return on equity. So that's just the stock. And the beta S is the systematic risk of equity. So this is just the slope of the returns to the firm if it was all equity with the market returns. Now I'm going to introduce analogous terminology, but for the debt of the firm. So B is the market value of outstanding debt. So debt are bonds, right? So you need to take the price of the price of outstanding bonds times how many bonds there are outstanding, and you will get B. The return on bonds is the yield to maturity on the bonds. Now you could have many bonds for a firm, okay? This is oversimplified in that I'm just referring to one, and we're going to do the calculations usually with one type of bond for a firm, but a firm could issue many different bonds, longer term bonds, shorter term bonds. But we simplify usually and just deal with one at a time. Okay, so RB represents the return to bonds. Beta B represents the systematic risk of debt. So that's going to be, well, we're going to talk about that. That's where we're headed. Okay, so I'm going to introduce the notation then, where V is the market value of assets of the firm, the return to assets, so that is the expected return to the average investor in the firm. That's how I'm going to refer to it. The average investor. The average investor is like any average, might not exist. It is a representation of a person who's an investor that is equally invested in the firm as the firm has issued stock relative to debt. So the portion of the value that is attributed to stock and the portion of the value that is attributed to debt is important to us. Okay, the average investor is invested just like in the same proportion in stock and debt as the firm is in issuing it. You'll see what I mean when I show you the numbers, I think. Okay, so same with the beta of assets. So this is the risk as measured by the systematic risk of the firm that has both stock and debt issue. Okay, so we can separate, and this is how I deal with this. You can talk about purely stockholders, or the equity portion of assets, or you can talk about purely bondholders, but the firm answers to both, or it has to pay a return to both types of investors. The average investor has a little bit of both in proportions equal to the relative proportions in the valuation of the firm. So you'll see what I mean with the fractions here. So what am I talking about? All right, back to the notation again. So S is the market value of outstanding stock. RS is the return to stockholders or shareholders. B is the market value of outstanding debt, and RB is the return to bondholders. S plus B is the value, and R assets is the return to the average investor in a firm. If a firm is all stock, then because beta would be 0, so that's the value of outstanding debt would be 0, then you would just have 100% S. This would be the fraction of stock to the value of the firm. So remember, S plus B is V. So I could put a V. You've probably seen the notation where this is, the whole thing is called V. I like to do it this way. And then because here B is 0 for an all equity firm, if this is 0 and this is 0, then this share, this fraction is 0. Okay, so for an all equity firm, this ratio is 100% and the ratio for debt is 0. An all debt firm would have a ratio of 100% for debt to value, where S would be 0 and 0 for the ratio or the fraction or proportion of stock. A levered firm has only average investors. This is how we approach this. It'll have investors that have a proportion of debt and a proportion of stock invested in the firm. And these proportions are identical to the proportions of debt and stock outstanding. Okay, so I repeated myself a bunch of times, but I hope that helps if you get confused. All right, so more terminology. So you've already seen this. I mentioned this. Notation. If your firm is all equity, that means that our assets, the only assets are going to be stock, so these are the same thing. If you have a firm that's only has bondholders, no shareholders, then our assets, the only assets are debt, so those would be the same thing. But if you have a firm that has part stock and part bond outstanding, or they have, in other words, shareholders and bondholders, then we use WACC. WACC is the weighted average cost of capital. So there's the average right there. It's A in WACC. It's the required rate of return of the average investor in a levered firm. And at the same time, this is what investors expect. It's also what the firm has to pay. It's their cost of capital. Okay? So this is the investor perspective, this is the firm perspective. So my notation now, what is WACC? Because we're talking about like a portfolio, right? We're putting two things together. We're putting equity and debt together, putting stocks and bonds together. These are like two classes of securities combined. So we're moving away from just talking about risky assets, and we're incorporating assets that are less risky. Okay, so we did talk about the risk-free asset, the T-bill, but that's different. Now we're talking about the firm's debt, the firm's bonds. So what do we do with that? Remembering the return on our portfolio is equal to the weighted average, right? That's just the weighted average formula. Don't be intimidated by that. So we're going to use that for weighing the returns to equity and debt. All right, so now let's pause. So I just said the same thing many times. It's like a kind of like a microscope. We're going, closer and closer in. Now let's stare at this, and you're going to tell me what is going on here. This is the proportion, so this is like the weight. Okay, so if you see this as the return on a portfolio, this is the weighted average return. This is the weight for stock, and this is the weight for debt. Okay, because this is the proportion of stock, and this is the proportion of debt in the valuation, or in the relative to the value of the firm, right? Remember, value is the capital. Capital is the assets are what's owed, stocks and bonds. The stockholders and bondholders have to be paid. So this is the relative weights. This is clear. That's the return that I'm going to weigh with this return. Now, what is going on here? What is this? Explain this to me. It says something here, after tax cost of debt. What is going on here? What's the story behind that, doing that? Why do we do that? Psalm 1, save the class. Come on. Why do we do that? What is that? What's going on? No one? No one saved the class? What the heck? So this means that I'm telling you something none of you realize what this is. All right, so it is the case that bond payments, so coupon payments to bondholders, are a cost of the firm and can go in as a tax deductible expense. So for every dollar, that's what this represents, for every dollar, right? Because these are all rates. So for every dollar paid by the firm to bondholders, they save. They get to save on their taxes. So this has to go, this reduces what is actually being paid out. It reduces the cost of debt from RB to a little bit smaller, 1 minus TC. So there's an incentive here for firms to issue debt because it's a cost saving mechanism. That's a foreshadowing of what we're going to talk about with capital structure, okay? Got it? Tell me you got it. This is a smaller number. If I didn't have this, this would just be RB. Because I have this,
the cost of debt goes down. This is going to make it a smaller number because this is a fraction. Remember, this was, if TC was 40%, then this would be 60% times. So it's just a fraction of the cost of debt. So because debt payments are tax deductible, so I write it here, I say the firm pays bondholders interest payments, right? They're making these coupon payments of RB for every dollar invested. And we can discuss, this is RB, this is the yield to maturity. That could involve coupons. There's an inherent, anyway, we're going to talk about the details about this, but the idea is that payments are made for every dollar invested. However, the firm also incurs tax savings. Remember this symbol? This is like TC, this is like the tax shield thing, right? Remember, whenever you have a tax deductible amount, so in this case RB is tax deductible, then it's like the tax shield. Because of the mathematics of it, this is the tax savings. Go back to net operating cash flows to see this calculation. That's what that is. So for every dollar invested, there's tax savings of this amount, like the tax shield of debt. That's what we're going to call this. Therefore, the cash outflows of the firm to its bondholders and the cash inflow to bondholders of the firm for each dollar invested will be this. So I'm always referring to the perspective of the investor at the same time as the payments as from the perspective of the firm. So the firm pays this, bondholders receive this, so this is what they're getting. All right, so that is the discussion of return. Now let's look at risk. So that WACC is the average return measured as a weighted average. So the weighted average cost of capital, that's return. What about risk? Risk is also an average. Risk is a weighted average of the portions of risk. Okay, so it's a weighted average of the inherent risks, all the risks. So there's the risk from stock and the risks from bonds. Now this is going to be considered, this has to be the after-tax cost of debt to be able to do this. Net of taxes. Again, I'll explain in more detail how to do that. And so this is a weighted beta. Weighted beta. That's how I'll refer to it. It's a weighted beta. Did you sleep? Weighted beta. Usually the beta of debt is close to zero. Why? The beta of debt is close to zero because there isn't too much risk. It's not as much risk relative to stock. Creditors have a predetermined agreement to how they will be paid. So there's less volatility in the prospect of their returns, different from securities, right? There's no guarantee that a stockholder will be paid. The firm can decide whether to pay dividends, whether they make, well, first of all, if they make profit. If they don't make profit, there's not going to be any return. But if they make profit, the firm still has to decide if they're going to pay dividends to the stockholder or reinvest in the firm. That could affect their dividend, and it could affect their market value. Both of those portions go into calculating the return from the dollar return, as discussed at the beginning of this topic in risk and return. But so debt beta is very close to zero. From here I could calculate with that estimate, suggesting that beta would be close to zero. The beta of assets could be estimated just with this fraction, this portion. Right? If this is just close to zero, then you can just pretty much ignore it. You could, if that's the case. So it turns out, in general, the beta of equity will be greater than the beta of assets. So the beta of equity in the firm is even riskier than the assets of the firm as a whole. What is this saying? They're saying that the weighted beta will be less, this is the weighted beta here, will be less risky. So the firm will be less risky when it takes on debt than if it was an all equity firm. That's usually the case, okay? All right, so now let's go to our exercise of the UAR problem, and then we can look at some exercises in the review. So I gave you some information there in the case part 2, where I explained that we're going to continue using the return on equity of 5.27 and we are going to introduce the debt for the firm. Now, if you go back to, let's look at that question paper. Hold on. So I'm going to part 2 of the UR case. And you're told here that you're told in it number 3, so we've done the other ones. I have some sort of virus in this. I need to fix that. Number 3. Assume UAir is a levered firm. It has debt on its balance sheet. given that 53% of the assets in market value is financed with equity and 47% with debt, estimate the WACC. All right, so I gave you that information, so I didn't get that out of thin air. So that's where these numbers came from. 53 in equity. So sometimes I'll just give you this ratio, and other times you have to actually compute it. Okay, and it's 47% for debt. The tax rate is 40% for this problem, and the return on bonds, you're told the yield to maturity for the bondholder I'm just going to double check. Yeah, in the you're told in the case, part 2, that long-term bonds are currently traded with 6.04% annual effective yield to maturity. So just to make a point, to do this, you need to have the effective rate. So this reflects the yield to maturity. So it's putting together all the information, right? Like this is what essentially the investors are going to get. This is the required rate of return you use for valuing bonds. So this is the effective. Annual effective rate. This is the annual effective rate. Okay, that's really important to tell you because you might not get it like that, right? Bond yields are stated rates, so you're going to have to convert it. So mathematically, you put this all together and you get the return. So what you've calculated is the required rate of return for the average investor in the firm, and it's also the cost of capital for the firm. Okay. So, now that we are looking at you as both an equity and debt issuing firm, and the average investor expects a return of 4.498%. We're going to evaluate the project with that rate. Now that's even lower. The lower return gives an even higher NPV. So we still invest. Remember, the internal rate of return was just using the cash flows. This doesn't change, right? What's different now is that we put a different discount rate if we calculate NPV. The answer is still to invest because, well, this just went down. So that decision isn't going to change. Okay, so this is determined by the cash flows. This is the required rate of return for investors in the firm. The project well outdoes that expected return. Okay, so another twist. Another twist is, what if we find out all right, so what if we add the twist? You add the twist that we should use a different beta for the Bahamas project than the other firm's operations. So when the project, and this is also explained in the case, when the project and the firm are not from the same line of business or has different considerations than the firm is used to, you should use an industry beta. You can get this information. You can find information like this in Yahoo. You can find information like this using historical information. You could calculate it. But where you don't have previous information, or there's a startup that's novel, completely new, revolutionary, you don't have previous data, so you're really just guessing. You're educated guessing, but you don't have quality data, quality historical information to incorporate. When the project risk is inherently different, you might also have to use different beta than the firm. So in this case, we say the beta here is higher. Okay, so there's more risk involved, profits are uncertain, whatever. We come up with the idea that we should be using a higher beta. Let's say the beta is not 1.55. We think it's 5.5. Much higher than the firm itself. Where do we begin to incorporate this? We have to go back and get the expected return for the Bahamas project particularly. We do this, we can use the CAPM to do this. Again, I'm using the data that's just closer to the year that I was interested in. Not all the historical data. And I compute a much higher expected return than before. Putting that together with the debt, and remember this will weigh it down, it'll make it a lower WACC than otherwise, let's say it like that. And just turning out the mathematics, this is now with the riskier beta. This is now required rate of return. Now this is different from the 5% we were using previously. Now put that in perspective with the IRR. Remember, the internal rate of return is only based on cash flows. Now that was 10.26. If the required rate of return with this level of risk in the Bahamas line is 10.32%, now you do not invest in the project. So again, you see the sensitivity of the project given your assumptions. The sensitivity of pursuing this project is revealed. We should not invest right now. It doesn't project doesn't satisfy the requirement. Okay, so I hope this didn't feel like too frustrating. I keep on changing the assumptions. You guys can review the video. That's exactly what I'm doing. I'm changing the assumptions. That changes all the calculations. I mean, we only change one at a time, but if you look at it as a whole, we changed a lot of things given our assumptions. We're changing, and we have most of the time we say to invest in Bahamas, but we end off saying we should not invest in the Bahamas line. And you can think about, the effects of, all the other variables, like what, the T-bill rate, the current T-bill rates are so low. How is that affecting your project analysis? If they maintain these low rates, the T-bill rate I used here, I think, was 1%. Let me go back. So if you go all the way back, we're just using this formula here to estimate the return on equity. Higher T-bill rates will put a higher rate of return or expected return. The fact that they're low currently and they remain low, the question is, well, how is that going to influence your projects? The lower expected return, right, is an incentive to do more projects, because it's less difficult to meet the expectations. So that's how T-bill rates, these are determined by the government, either incentivize or disincentivize investment or growth or development or the economy. Okay, so low rates incentivize projects in the private sector. All right, so I could expand the WACC. I could think of different asset classes like preferred stock versus common stock. Actually, I'm going to send you an exercise. You can practice this. All I do here is I add another component. So it's just like a portfolio where I have the weighted returns to the different components, different stock in the portfolio. Here I have stocks and bonds, and I put them in equal weight. So don't get intimidated. This is just one addition to the weighted calculation. So preferred stock the preferred stockholders are paid before common stockholders. So they have they're not as risky. Their expected return shouldn't be as high as common stock. So I'll usually use this for common stock. And you can read about that, or if you haven't already, I think I did put some questions in the Connect, so to force you to read a little bit into your reference material about stocks. And this is for preferred stocks. Okay, and I'll send you an exercise on that. All right, so we have like 45 minutes, an hour left. What would you guys like to do? You want to do some exercises? I'm going to take a pause and put in the chat what you'd like me to look at. Okay? Let me take a break, 5 minutes. I'll also send you this last question. All right, I'm back. So you want me to do reviews exercises and from 2 and 3. Let me see what I can do from 2. So let's take 45 minutes, 50 minutes to do some exercises together, and then I will mail you the material for tomorrow on Friday, and that will be it. Can you believe it? I can't believe it. Let's see, review 2. Okay, so I did this on your review 2. Well, you should be able to do review 2 now that I talked about this material. You should be able to follow what I did today to replicate, you can replicate what I did to answer these questions here. But I can also talk about these some more tomorrow. Unless you have specific questions about review 2 right now, I'm going to jump to review 3. Because I did those kinds of things just now. And then we can look at review 4. Review 3. Oh, that's review 2. Review 3. Okay, this is a lot of calculations. Okay, I really like this one. Let's do number 2. I should get the blank one, shouldn't I? Let's go number 2. Review 3. Number 2. Actually, if we just finish this one, it should be good enough. So CanWest Media Company has the following capital structure. Common stock and bonds. The stock is valued at $34 a share. There are 1 million shares outstanding, so that's $34 million total value of equity. So that's for stock. Bonds are valued at current price $975 a bond. There are 45,500 bonds outstanding for a total value of 44,000 and some. So what you could do, no, it's 44 million, sorry. So what you can do is check these numbers, okay? So I give this to you. In the test, I probably won't give this to you, and you have to calculate it. It's going to be a big mess because you make one mistake early on and it just compounds errors. So to avoid that, I've given everything to you here, but you should be able to calculate all of these. These could be calculated on your own with just this information. So I can calculate the share as, actually, this one.
Actually, it should say S or B, right? Because this one is with B. So this is B over S plus B. So this is the capital structure. That's what we call it. All right, let's see. What do we have as information? So assume risk-free rate is 4%, rather high, but we're going to use that because I didn't want to update this old exercise. So the risk-free rate is 4%, and the expected return on the market portfolio is 15. Okay, so that's the portfolio of assets that we assume all rational investors hold. They hold a combination of T-bills and the market portfolio, and we imagine that together investors invest in a combination of the two. I think I'm going to give you one more handout. That focuses on that kind of a mix. I'm going to give you one more handout after we get off, and we can talk about that when we start tomorrow before I get into the capital structure material. Okay, so we're going to we're going to focus on CanWest equity. CanWest equity has a beta of 1.2. The bonds have a stated annual coupon rate of 13%. Coupons are paid semi-annual and the bonds mature in 6 years. CanWest pays a 45% corporate tax rate, and each bond has a face value. Okay, so what do we have to do? We need to let's start with the expected return on CanWest equity. So I'm doing this step by step. I'm giving you all the things you need to get the WACC, right? So this is the return on stock. B is the return on debt after tax. The beta of debt and the beta of assets. Okay, so yeah, because I have the beta of stock, you don't have to calculate that. So you don't have to calculate that one because they give it to you. And then in the end, you're going to get the WACC. Okay, so this is it's very systematic. You go one thing at a time and combine them. The only real choice you have is whether you want to use CAPM or, well, it depends what you want. Ultimately, we want all of these things. We want the WACC in the end. And WACC is a weighted return computation. So you're going to do that. You're going to calculate the weighted return. So weighing together the return on debt and equity to get WACC. Alternately, you could get WACC using the beta of the firm. So this is where I'm headed. I have like 45 minutes to do this. Just let me know in the chat when you want me to slow down. Okay, so let's do this together. Try not to look at the answers right now since I'm here with you. I will help you step through this. So for the first part, how do you compute the expected return for CanWest equity? Let's start there. So how do you do this? Ideas? Without looking at the solutions? What am I asking for? So I don't have the information on the returns to CanWest. Do I? I don't have like historical returns. I don't have ex-ante returns. I don't have that information. But they tell me the risk-free rate and they tell me the market rate or the market portfolio return. So that means, what can I do? What do I do? I have information on the beta, the risk. Now what do I do? Whenever you're given information on the risk, you need to remember that you have a method of tracing risk to return through the CAPM. So once you have risk, you can compute the return through the CAPM as long as you have the other information. So you're going to use CAPM to do this. Okay, because you got information on the risk, the market portfolio returns, and the risk-free rate. So without looking at the answers, compute the expected return on equity with the CAPM and put it in the chat. No cheating. No one? No one's got it yet? All right. It's too long. You guys are taking too long. Let's see what I can do. Let's see. Expected return. So we're going to use the CAPM. CAPM. So that is going to be the formula, right? I'd like you to remember it as a relationship, but maybe that's asking too much. But all you got to do is the expected return. So let's see. The notation I'm going to use is similar to what I've been doing just today with RS. I could write it like that. Is equal to a markup above the risk-free rate, adjusting for every unit of risk by the market risk premium. All right, so the market risk premium is just the 15 minus 4, which is 11. So this is 11%. I can write it as a percent. I can write it as a decimal. This is supposed to be a plus. The beta of risk, the beta of stock is given as 1.2. So wait, let me write it as a decimal just because. So this is 0.11, this is 1.2, and this is 4%. 0. As long as you're consistent, you'll be fine. I'm going to use decimals across the board as for the rates, or I use whole percentages. As long as I use them in both places, I'll get the same answer. I'll get the right answer. So putting that together, what is the expected return on stock? Anyone? Come on. Excellent. 17.2%, Alex. Okay. 17.2%. So either you had 0.72 or 17.2. So we've answered part A. Very good. Next step, for people who've already done that then, the next step is part B. Compute the after-tax cost of debt. So what you have to do is find the effective yield to maturity on the bond, using the information you've been given and your knowledge of bonds. I want the effective return, the effective, how did I refer to it? Yield to maturity. All right, the effective yield to maturity, annual yield to maturity, and I need it after tax. So then you first get it and then you multiply it by 1 minus the corporate tax rate. So now that I got it, okay, so can I erase this to get my space? So that'll be 17.2. Take a screenshot before I erase it. Okay, I'm going to erase it. Next, so this was 17.2%. Next, I want to get RB. So this is the return to debt, and I want to multiply it by 1 minus TC. Remember, because from the perm perspective, they don't have to pay the, for every dollar they don't have to pay RB, they get a tax savings, and that's captured here. Okay. So, what do we have? We have information about the debt, the coupon rate, semi-annual. That means that this is a stated rate. We have to divide that by 2. It's 6 years, but that's 12 semi-annual periods with a face value of 1,000. Now we have to figure out the yield, and our calculator will do that for us. So in a test situation, you have to write the whole formula for me. So you never get to forget anything. It's only been 2.5 weeks, so you shouldn't have forgotten. To calculate this, you will need the price. Oh, we have the price from above. Let's pull that out. The price, you're told, is right here. Look at that. So $9.75 per bond. So you have the price. $9.75, and that's equal to the coupon divided by 2 times 1,000, right? So it was 13. 13 divided by 2 is 6.5 times 1,000, $65. So this is $65 payments at the rate that I'm interested in. I'm just going to put I, and then remembering that this is an annuity of those payments. Remember, this is what I want. I want the I, and I don't know it. And it's going to be for how many years? Right, so 6 years or 12 payments. And I'm going to add that to the $1,000 face value divided by the rate for 12 periods. Now I notice on the first test, a lot of you missed this term. Don't miss that term. Okay, it's an annuity plus the return of the face value of the bond. So that's the formula that you write. Enter that information into your calculator, remembering that $9.75 would be a negative, and these two amounts will be positive cash flows. And then you will be able to solve. Okay, so the question is, how do I know that this is 65? Because look what it says. It says stated. The stated annual coupon rate. Unless are you saying my clave is wrong? Stated annual. So this is stated annual. That means it's an R1/2. I'm just going to check to make sure I did that in the clave. Yeah, that's what I did. Okay, so I know it because it says stated annual. It doesn't have to give notation. It just has to say stated. If it's stated annual, it's you assume this is this is treated like a R1/2. Now this is remembering this is the coupon rate. What we want to find is the yield to maturity, which is also a stated rate. So you have to divide by 2. Okay, now put this in your calculator and you get you put 12 into N, nothing in I, Y, because that's what you want. Price is 975 as a positive. No, sorry, as a negative. And payments are 65 as a positive. And remember, for bonds, you enter all the values for coupon bonds. Face value is 1,000. Compute the interest rate, and what you get is 6.811. But that is, and if that's a stated rate as well. So you need to convert it. You need to convert it to an effective rate. You see, you get to use everything you know. So this is EPR 1/2 because the formula only gives you effective rates, but you need to convert it to the right effective rate that you need for the rest of the problem. So this is 0.068116.021, or you have it in percentage, right? So I'll write it as a percent. Let me do that again. 6.8116, etc. percent. And converting it means that you have to use the effective to effective conversion formulas. So 2 of these, and you should put this in your stored, you should store this value. This one should be in storage 1. You square it, and don't forget you have to minus 1 to get the effective annual rate, right? 2 of the small ones makes the big one, the annual rate. 2 of the portions makes the whole. So let's do that with a recall button so that we don't lose the decimal places. I don't think it's going to make that much of a difference because we're only doing 2 years, but just so we get the same answer, let's use the same approach. So I get the value, I store it, so I recall 1, I would have to divide it by 100, where I have the decimals, plus 1, square it, minus 1. And it's 14%. So that is I'm always going to use 4 decimal places. 0.872%. All right, so it's 14%. before tax. Now multiply it by, well, what's the tax rate? Corporate tax rate, 45%. So then this needs to be multiplied by 0.55. So are you with me? So what you found is this is RB. RB this is RB. So then RB times 1 minus TC is RB times 0.55, and you get 7.748%. Questions? This is not hard, it's just a lot of steps. You gotta hang in there and not lose sight of where you're headed. Now I have, it's all neatly written out in the clave, so I apologize for the messiness, but I make up for it. Okay, so we have that value that I'm going to erase. So take a screenshot if you need it. Got it? So what I do in my notes is I keep 4 decimal places for my rates. Sometimes I don't. I keep more. No, 4 as a percentage, 6 as a decimal, okay? So that's the rule that it seems I've used throughout this solution set. Okay, so 4 if used as a percent, or 6 if used as a decimal. All right, so next. What we're going to do next, you're asked to find the beta of CanWest bonds. Remember the relationship between risk and return. If you have the risk, you can compute the return with the CAPM. If you have the return, you can compute the risk with the CAPM. We have the return for the debt after tax, so we can use it to get the risk of bonds after tax using the CAPM. That's what we're going to do. So I'm going to erase this. Just cleaning up my space without deleting everything. Okay, oh, that worked. Oh, I like that. What happened? It deleted nicely. Oh, see that? It's too much. No.
Okay, so I cleaned that up. I got 7.748 for that. And now I'm going to use CAPM again for this part. So using the return on debt, I can find the risk for debt. So let's put that together. CAPM again. The return on debt is after tax is 0.07748, and that's equal to, so this is the expected return on debt after, usually I write after tax, or I put something here to differentiate between not after tax. And that's equal to the risk-free rate which I can write with lowercase or uppercase. I keep on changing. You should be comfortable either way. So I think I'm going to use what I have here, risk in the notes on my solutions. The risk-free rate is 4%. And then you add to the beta, which we want to find. So this is the B after tax beta. I won't even put it in because there's no room, but that's what I'm going for. And then the risk premium, which we know is 11%. Okay, so solving this for beta, what is the beta? All right, what did you get for beta? I'm just going to write out the formula. If you're still confused what I'm doing, this is the market risk premium. And that's what I'm using to compute. Okay, so if you solve this, your beta will be 0.3164. Is that correct? No, it's not. I don't get that number. I get 0.34. 0.3407. That's right. 6 decimal places in decimals. 4 decimal places if written as a percent. Okay, so let me verify that calculation. So some students may have decided to put formulas in Excel to do all these calculations for them, which is fine, but remember on the test you're going to have to write every formula down anyway, so just letting you know. You still have to know the formulas with the number, how you punch the numbers in. So that is the correct answer. So take a screenshot. I'm going to erase what I've got on the screen. I'm going to put my number here. Okay, so let's erase this. Put in my values. So far I've got, this one is, remember, 7.748. That looks terrible. Let's do that again. 7.748%. And then the debt is going to be 0.34. So you see it's less 0.723. So you can have a beta that is less than 1. I think that's, we haven't seen that yet. So yeah, you can have a beta that's less than 1. It's less sensitive than market returns, right? Which is anticipated because it's not as risky as risky assets. And risky assets go into computing the market return. So that's that. Now let's do the next step. The next step is the beta of CanWest assets. All right. So I have the beta. This is the trick here. So this is the beta of debt after tax. This is the beta of stock. That doesn't have to be after tax, right? That's just like that. That's not affected by the tax rate like bonds are. Okay, and you can just actually make the weighted beta of those two to calculate the beta of assets. So the weighted beta means that you have to consider 1.2 times, you have to weigh it by its relative significance for the firm and their asset valuation. So for stock, that share, that weight is computed over here. It's 0.433881. For bonds, it's 0.56619. That was computed by doing computing this ratio, stock over V, right? So let's do that. So we're going to use the weighted beta formula for beta of assets. So this is for the firm. It's a weighted beta of S over S plus B times beta of S plus B over S plus B times the beta of debt, which I can write as with a little b, and after tax up here. That's sort of what I did. Or I didn't distinguish in the solutions for this, but that's what you assume it is. I'm going to put it in anyway because I'm used to doing that. It just gets tedious for you to do it. Just have to remember that's the one we used. Okay, when you put it all together, what do you get? So for this one, you'll use 0.340723. For this one, you use 1.2, and then you use the weights up here. I'll give you a few minutes. You got a number? Numbers, good. 713547, very good. I'll give the others a few minutes. Do it while we're together so you can ask me questions. Very good. One more person. So as I said, you have, these are the solution sets to questions that are similar to the questions on the exam. So when you study this, you're studying for the exam. You're not wasting any time. Okay? I'm going to post the Connect problems. Well, it's Wednesday already, so yeah, I have to post them today. And they will be due on Monday, I promised you. So you'll have some time to do the test. Okay, Louise got it. All right. And then finish the Connect comfortably. All right. Please, I'm available to you until the test. The test will be Saturday, so make sure you ask me your questions soon. It's only 2 days away. I know. But like I say, you're studying for the test right now as we speak. All right, so a few people got it. The rest, you can take a screenshot or work on it. I'm going to go to the next one. So what we found is the beta of assets as 11. So this is the WACC. No, sorry, that's not the WACC. This is the beta associated with the WACC. That's not a percentage. It's just, I'm copying the wrong number. I'm jumping. It's 0.713547. And that's a decimal. You interpret it as the sensitivity of CanWest's returns to the market returns, and it reflects the expected returns, the
it reflects the slope relationship of the returns to the firm against the market returns. So now, that's the beta. Now from this, we can calculate the return. I just realized I probably was saying the last answer. So we've calculated the beta, the risk associated with the returns to CanWest assets. Now we're going to calculate the return. The weighted average cost of capital for CanWest. You could do this two ways. Either average the returns, the weighted average, okay? The weighted average of the returns, or CAPM. You should be able to do it both ways. You should be able to do this as a weighted average of these two, or using the beta in the CAPM formula. So I'm just going to flash up what I did. I'm going to show you with the solutions because it's so much neater than this. We're almost done for today. So I did both methods in the notes, so you could see that, and I just want to illustrate something for you after this. Here you go. So the WACC is going to be 11.849%. If you use the approach of the CAPM, putting these numbers in, you get 11.849. You use this is the market risk premium, this is the beta of assets as a markup over the risk-free rate. The other way is to compute the weighted average of returns. So the weights that you know with the return on S and the weight that you know with the return on after-tax cost of debt, which you calculated, and you should get the same answer. You should know both methods, okay? You should be comfortable with both methods, because sometimes I won't give you enough information for one of these, so you're going to have to do it the other way. So that is what I want to say about this handout. One more thing is that you could map out, and essentially, why does this work? It works because all of these assets in efficient markets fall on the security market line. They all fall on here. So it means that if everything that falls on here is just a weighted average. Oops. So remembering that here you put, it's a trade-off. It demonstrates a trade-off between risk and return for all assets. Right? And if I was to plot in this space, the CAPM traces the assets
risk and return with the blue line, the stock with this higher red line, and the debt with the lower red line. You'll notice if you check all of these numbers and try and plot them in this space, this will represent stock of the firm. This down here will be the debt, and this will be the asset, the assets as a whole. You can check it, you can check the numbers, you'll see that risk and return for stock is higher than risk and return for the debt, and I can call this the after-tax cost of debt, right? Because that's what we're using. And then in between will fall the assets of the firm as a weighted average of the two. All right? So you should be able to see that in all the numbers. So what does that do? You know you have the wrong answer if you can't, if you don't see this, okay? You calculated something incorrectly. Stock risk and return should be higher than debt risk and return, and the assets, the weighted average return and the weighted average beta should relate through the CAPM as somewhere in between. If there's more stock, it's closer relative to debt. The blue line will be closer to the stock numbers. If there's more debt relative to stock, it'll be closer or lower with the debt numbers. All right, so it's 12 o'clock, and I've kept you long enough. What I'm going to do is I just sent you one other practice assignment. I'll send you one more. I will send this one without the solutions, and then tomorrow I'll send you the solutions so you can try without the solutions to work through those. Tomorrow we'll start the new material, which I'll also send you. And that's it. If you have any questions, please email them, or we'll start tomorrow's class with some questions. If you have questions now, you can ask me. I'll stick around. If you need to go, then have a good day. Bye. I'll just stick around a couple minutes if you have any questions. You're asking me, Carola, about the exam. The exam will be just on the new material. So just on this stuff. So on risk and return CAPM, cost of equity, there's this new stuff. And yes, and capital structure. No, this capital structure discussion. Like I've already introduced the notions of capital structure, but I have to teach you a little bit about some theory, and I think that's going to be it. What I send you today will be the last material, okay? So then Friday I can just answer questions, hopefully, and that's it. I'm supposed to say something about dividend policy, but I don't. I'll see. I'll mention something about that, but I won't put it on the test. Okay, everyone's filtering out. Let me know. Write me an email if you have any concerns or questions. You guys are doing great. You're amazing. Very impressed with you. Keep at it. We're almost done. I can't believe we did it. You guys are really, really incredible. I'll be available, okay? So email me or text me if you have other questions. Otherwise, I'm signing out. Bye.